Stocks in the green this morning as companies like JP Morgan report upbeat earnings that seem to be uplifting the sentiment among investors. To talk more about the third quarter earnings season, Michelle Schneider is joining us. She's managing director at Market Gauge. Michelle, good morning to you.
Good morning to you.
So what are we to make of the Q3 reporting we've seen thus far? Is it fair to say that the inflationary pressures have yet to really hit these results?
I would say that's a pretty fair assessment. I think we're really going to see the influence of that more as we go into the fourth quarter, so that the banks, which have all reported extremely well, you can see the reaction in terms of the price in the stock is muted relative to how well they've done. Like, for example, yesterday, JP Morgan got hit with selling after it had amazing results. And this morning we had Morgan Stanley, which has come in higher. But again, it's not really clearing major resistance. So it could be relative to the inflationary pressures. It could just be that the sort of a sell the news type of situation, with the good news being so much priced into the market in terms of earnings. And like you said, with a lot of expectation of the havoc that inflation can continue to wreak as we end 2021 and go into 2022.
So that's a really important point, the bar being set particularly high for the major financial players. So at what point will investors' expectations perhaps match the reality of the business situation that the banks are facing?
Well, what's amazing is right now, if you're looking at the key intermarket relationships that really give you the best assessment of the risk appetite of investors, you want to look at the high yield debt bonds versus the long bonds, which right now the high yield debt bonds is still outperforming the long bonds, which means risk on. You want to look at the S&P 500 versus the long bonds, and the S&P 500 is still outperforming the long bonds. And you want to look at something like transportation that's going to measure demand. And right now, if you look at transportation versus the S&P 500, that also is outperforming. So right now, the market is still very optimistic for really, we can't say exactly why, because you have things like PPI came out a record high today at 8.6%. There's a 700,000 barrel deficit of oil globally every single day. We have rising costs of food and gas. And so all of these things, and the market, the market can run alongside inflation for a while, but then at some point, of course, enter the Fed. And that's really going to be the key. They are being very sort of wishy-washy in terms of, yeah, we're going to taper, yeah, we're going to raise, but we're looking at the labor market. And obviously, there's still some real issues in the labor market. So I think you've got to watch those key relationships, and they will tell you when the risk appetite changes.
So is that going to be the wake-up call for investors then, when Fed tapering actually starts, as opposed to just looking at the Fed minutes and saying, oh, they're talking about it might be next month or the month after, or, actually seeing the rubber hit the road and a real pullback on the emergency support that they've been providing?
I would imagine it'll be somewhat of a wake-up call. Right now, they're talking about buying less by 15,000 a month, with totally ending it by the middle of June 2022. And so perhaps when it actually starts happening, it will shake the market a little bit. But a lot of traders have already priced it in, which is why we're seeing the long bond yields go up and the TLTs actually go down. So I think what would shake the market is not what they've expected to do, but if they do beyond what they're expected to do.
Right. If there's actually a surprise that hasn't been baked into the market at this point. How much of a comfort is the term transitory to traders these days? Because it seems like such an amorphous term that can apply so broadly. Inflation is transitory. I mean, that is quite literally true no matter how long inflation lasts, So at what point do we end up dropping the term transitory and embrace the, perhaps not so positive reality that inflation is going to stick around for a while?
Well, some of the Fed members have already dropped the word transitory, and so it's happening. And even people who were really sticking to their guns about transitory inflation are starting to speak about it becoming a lot longer lasting than what anybody anticipated. So I say that in terms of the word transitory, it really depends on where you look. certain aspects could be transitory, like, for example, the used car market or the rental car market. These are things that might actually come back. The new car market, of course, is affected a lot by the chip shortages. But in terms of some of these other transitory inflations, it's unrealistic to think that, for example, with food prices, if we have any kind of rough winter, which we already had a short supply with supply chain problems and labor problems, that transitory word will happen. We're at 40-year highs in terms of food prices with no real sign of that abating, and you don't just grow more coffee or plant more wheat and corn and then poof, everything magically turns around. So I think that the transitory word was very politically motivated word to try to make people feel better, but everybody's starting to realize that. Go to the gas station, heating oil, could be shortages. And that's really what's going to pinch people's pockets on top of what's already pinching their pockets with just food and basic supplies.
So I think that's a key point that we should stress here, Michelle, and we just have about 30 seconds left, but isn't that going to be the real sort of sting of inflation? Because people don't buy used cars or even new cars regularly, whereas, we buy food every time we're hungry, which for me is every 15 minutes or so. So it's going to be a real challenge, isn't it, to try and keep consumer confidence high, keep consumer spending high, even for a matter of months if we see this food inflation progress continue.
Absolutely. And where you're really seeing that reflected in terms of consumer sentiment is actually in the retail sector itself. Although there are pockets that are doing better, it's more essential needs type and high luxury types because the wealthy aren't really impacted by inflation. So yes, I think it could hurt, and I think we can see that reflect in the market. And definitely, as we started the conversation with earnings, going into the fourth quarter as companies have to start cutting back because they cannot pass those higher costs to consumers, and it hurts their bottom line.